So, you want to start investing. You probably want to start investing in stocks. Do you want to become the next millionaire next door? If so, you should probably watch this video, because I can talk you at least through the very beginning parts of those steps. I'm definitely not a millionaire yet, but I kind of know how to get started, so let's get started. So here's the thing. I have, for the longest time, been interested in making a lot of money. I think that most people can probably agree that having more money would probably make your life somewhat better. I'm not saying it's the root of all happiness, I'm just saying that having more money can only lead, hopefully, in your life, because we're all average people here, into more happiness. So, that being said, you have to think, how do I make more money? Now, some people go with the approach of just focusing on career, trying to get high-paying jobs that give them a lot of money so they can save it. And that's a pretty flawed approach. We have this mechanism, especially in the United States, but of course in other countries, but I'm very US-centric, something called inflation. It's the idea that every single year, your money actually becomes less valuable over time because there's more of it available. If you have one $100 bill in your hand, over the next few years, that $100 bill and that day's buying power will be like $97 worth of money. And then as time keeps going on, it's worth less and less and less. It'd be like, let's say this is the only lens cap on the planet, this would be worth a lot of money. But if we have billions of these lens caps, it's worth nothing, it's dirt. So the more we have, the less valuable it is. So what you have to do is you have to find a way to beat inflation. And how do you do that? That's with something called interest rates. So with investing, your goal is to find an interest rate that matches or exceeds the inflation rate. So if inflation is 3% year over year, you want an interest rate that's 3% or higher every single year. Now, how do you attain that? Some people will tell you to invest in cryptocurrencies, and you shouldn't because it's probably a Ponzi scheme. See, the cryptocurrency isn't actually backed by anything. Something like the US dollar is really interesting because it's backed by the US government. Gold and silver is backed by its rarity and generally accepted value amongst the world. You can use silver and gold anywhere in the world and it would be valuable somewhere. Cryptocurrency doesn't have that luxury, unfortunately. So right off the bat, because I know people will probably ask about that, cryptocurrency for the average person probably is not worthwhile for an investment. You're very likely to lose your money. So how do we average people invest? Whenever I turned 18 years old, whenever I knew that I was old enough to be able to invest, I went to my father and I said to him, hello, I would like to start an investment account. Will you help me? And he agreed. So we used a website called Vanguard.com. Now you could also use Fidelity.com or any other website that allows you to do investing. Now again, just to be clear, you should stay away from cryptocurrency and also apps like Robinhood or Acorns or any of those like smaller investing apps. And we don't have to talk about why, just you have to trust me on this. Don't use weird little apps that let you round up the dollar. Use a real investing account that's backed by a large firm. So I use Vanguard.com. And what I set up very early on was an automatic withdrawal from my bank account that happened bi-weekly that would allow me to invest without having to think about it. Why is this really important? Okay, so you set up your Vanguard account and you decide to do a retirement target age of 2065, which is what I'm doing. The way you calculate that is you look at the closest year that you'll be retired or expected to retire, which is typically the age of 65 in the US at least. And you do a target date on Vanguard. And they actually choose your stocks for you and something called S&P tracking. It tracks the S&P 500, which is like the top 500 grossing companies in the United States or whatever, and invest in that. And what's cool about that is that you have a pretty expected range of return on investments, which is your ROI. So on average, over the span of over 100 years, the S&P 500 is tracked about, I think, 7%, which is much higher than the typical 1 to 3% of inflation. So you're year over year making money. So when you do this, you have a guaranteed way of making some money. Now, you're not going to become a billionaire, maybe not even a multimillionaire, but you will become the millionaire next door because you're doing a proven track record of actually making money. You're not investing in really risky prospects. You have a pretty good blend of safe companies that have a proven track record that pay out a good amount of money that aren't probably going to fail anytime soon. It's worthwhile. So when you sign up for Vanguard and you give them all their information, they ask you like, hey, how do you want to invest? You should choose the option that allows you to automatically deposit money bi-weekly, monthly, weekly, however you're getting paid, you should do that. So I take out about 20% from my paycheck, every single paycheck, so twice a month. And that money goes directly into my Vanguard accounts, and I don't touch that money. It goes into something that is called a Roth IRA, okay? Now, we don't have to get super technical into terms here, but a Roth IRA is a United States specific vehicle. It is something called a post-tax retirement plan. What does that mean? A lot of people here have heard about 401ks, which is your pre-taxed money. So before you even get any money taken out of your paycheck from taxes, this money can get invested. You don't have to pay taxes on it until you withdraw it. A Roth IRA is actually the opposite. So I've already paid taxes on my money, and now I'm putting that post-tax money into this retirement account. Why would I do that? There's one simple reason. Whenever I retire and I want to take money from this Roth IRA, that money that I'm taking out of it is not taxed. Any interest I make, not taxed. The principal, not taxed. So whenever I retire and I'm withdrawing money, I'm not going to have taxable income being taken from that. It's a really valuable tool. The money you actually see in your account is the money you'll actually get when you take it out. Unlike with a 401k, if you have $100,000 you want to withdraw, you're going to have to pay a certain percentage of income tax on that money you're taking out. So I prefer the Roth IRA. Right now, the max contribution you can do is $6,000 a year. My opinion is you should get as close as you can to maxing that out year over year. If you max it out every single year from the time you're 25, you have well over $1 million in principal in that account, if you're looking at like all of the money taken, okay? It's really, really important. So I contribute, I guess that would be, I think it's like $3,600 to $4,000 a year into my Roth IRA. And then over time, over the span of decades, you get something called compound interest, which means the money that you have in that account is actually growing and snowballing over time. If you have $100 in this account and you get 7% interest rate, the next year you have $107. The year after that you have like 118 or something, and it keeps going and snowballing over time. So because I'm consistently contributing to this account and it's also earning interest, eventually, probably a decade or two from now, it's going to snowball heavily and heavily give me a lot more money. And that's how you build wealth. You know, that's not how you become rich, that's how you get wealth. How you get a lot of money over time by having your money work for you. But it takes a lot of discipline to not withdraw that money, especially if the stock market ever dips. But if you can actually hold on, if you are something called I guess it would be a bull in the market, maybe it's a bear, I'm not sure, it doesn't matter. As long as you stay in the market, you'll continue to earn money on average over a long period of time. They have to usually wait 20 to 30 years to be able to show like a very consistent track record, but you will get there, and that's how you start investing early. I hope this video made some sense to you. I'm very happy and willing to answer questions down in the comments, and if I get enough comments, I'll make a separate video answering those questions. I am not an expert. I am not a financial advisor. I only know what I'm talking about based on what I do. That does not mean that my approach is the best for you. The earlier you invest and the younger you invest, the higher chance you have of winning. The later you invest, the more you have to make up the difference in time because of compound interest. I hope something here stuck. I am not a teacher, and I'm barely good at finances. But if you enjoyed the video, go ahead and give it a like. If you want to see more videos like this, ask for them in the comments, ask for topics you want me to talk about, I'll do them, and also answer comments down below. Do not forget to keep it casual.